Hi, today I'll talk about some personal finance stuff. If you are getting some money, you want to put in a money which is a policy of yours is maturing and you want to invest, that is the case is with me. So I was looking at some options and I want to discuss three options with you. One is ELSS, ULIP and PPF. Now if you're looking at an option for retirement, then ULIP is the best option. Why? I'll tell you. What is ELSS? ELSS is equity linked savings scheme, and this is a diversified equity mutual fund kind of a thing. In this, you get tax saving benefits under Section 80C of Income Tax Act, and deductions up to 1.5 lakh rupees per year against investment made in ELSS. Now the rate of return, if you talk about ELSS funds come under equity category, open-ended funds. This means that 65% of your money is invested in equity. The return in ELSS is dynamic, and this means it purely depends upon how well the stock market performs over a long period of time. You have to invest in for a long period. One thing that you have to keep in mind is that at least for 3 years, there's a lock-in period. You cannot move out of this for at least 3 years. And the return in ELSS are taxed at 10% without indexation benefit if they exceed 1 lakh rupees in a financial year. In comparison, PPF has a minimum lock-in period of 15 years, but over the past trends have shown that the investors have also expected and earned returns of around 12 to 14%. So that is ELSS for you. Then we come to ULIP, which is Unit Linked Insurance Plan. Now here insurance, as you can read in the name itself, insurance is included in the plan. I like this ULIP thing. This covers your life along with your plan, which is hybrid. So it's a healthy mix of equity, debt, hybrid funds. ULIP also gives you tax benefits under Section 80C, and when the policy matures, the returns are exempt from income tax under Section 10D of Income Tax Act. So this is the best part in ULIP. The rate of return may vary. Why? Because investor chooses to move from equity, debt, hybrid funds, and that's why rate of return may vary. And ULIP lock-in period is 5 years, and one caveat is that ULIP as in investment is not as diversified as ELSS. So these are two things. If you talk about PPF, which is Public Provident Fund, this has been favorite since 1960s, and decades later it still remains favorite. The lock-in period here is 15 years. That is the problem. However, you can withdraw somewhere around 7 years, a part of it, or take a loan from your PPF account after 7 years if there's a need or requirement. Section 80C benefit is applicable to PPF also, and also 1.5 lakh investment per year is exempt from taxation. Rate of return here is around 7.9% the current rate of return. And it is more attractive than FDs, fixed deposits. So these are three options. So we've talked about ELSS, we've talked about ULIP, we've talked about PPF. Minimum lock-in period, ELSS is 3 years, ULIP is 5 years, and PPF is 15 years. Okay, Rate of return, if you want to compare, ELSS is 12 to 14%, ULIP it may vary, dynamic hai, and PPF is 7.9% current rate of return. So I hope this helps, and I would go for ULIP.